To pick up where we've looked when we're talking about the global market, we just wanted to shift things around a bit and look at what is happening on crude on the water. And global crude oil on the water, you can see, is at a seasonally adjusted all-time high, highest for 2020, well, highest was for the highest of 2021, still remains elevated. So we're going to start off the year at a very high level in terms of what is out there, what is currently flowing. And now that we've seen an increase or the approval of another 400,000 barrels a day increase from OPEC, it doesn't mean that we're going to see the increase in production, because we have to look at what is happening with exports versus what is happening with production, because they're not the same. And I think that's sometimes where things can be, the miscues can come in, and you can see the difference between what is happening in the physical market and what is happening in the futures market. Because we have seen declines in ESPO pricing, so-called, in Qatari pricing. And this is off of a weaker price that was last month. So we're continuing to see a degradation of pricing. It's still a premium to Brent, but not the same premium that we've seen as we see the Chinese demand coming down. And the reason why is because they did a lot of their buying, and a lot of this is going to show up in Asia. And then when you look at the movements in general, here you can see that crude oil in transit is at the highest level, seasonally adjusted, highest level for 2021. And this was some of these movements as we had crude that was sitting in storage getting pushed into the transit market. And now we're going to see that go from transit back into floating storage, especially with some of the COVID issues that are starting to arise, especially in China and in Asia. But more importantly, China, they've cut the export quota, the import quotas, which again is going to leave more of this in the offshore market. And that's why it's going to be important to see when does it transition from transit into floating storage, and how long does it take for that to actually clear. So then when we look at crude oil in floating storage, it's fairly stable. We expected it to climb right back up to where we went prior into the beginning of November. Here we are. We expected it to be above 2020. We thought we could get maybe a potential spike above 2016, but it was all a matter of timing of when those boats went from in transit into floating storage. And clearly, some of that is still in transit, which is why it's not recognized in floating storage. But you can just see that we will start off the year at a new seasonally adjusted high above where we started 2021, just given the amount of crude that is currently in motion. That's going to put a lot of crude on the water when you look at floating storage, at least through the first 3 weeks of the new year. So then when we look at crude products, we expected to see a fairly steady drop just because things slowed down a bit, especially between Christmas and New Year's. Gasoline had a drop of 144,000 barrels a day, dropping 526,000 barrels a day. And that's when you look at Latin America, we can blame COVID, and I know COVID is the excuse du jour, but there is a real economic problem when you look at monetary and fiscal slowdowns, and the fiscal and monetary drag that's created from the massive amount of stimulus that came into the market in 2020 and 2021. That's going to have, again, essentially that sucking sound on demand, especially when you look at emerging markets, which are in a clear rate rising cycle, with the U.S. also heading into that level. Distillate had a decline of 481,000 barrels a day, bringing us 389,000 below the 5-year average. Diesel distillate into the international market, we think is still going to be a problem, especially because there's great margin in the U.S., so why export it? So that's going to be something that will be a bright spot when you look at demand here, but it'll be a headwind for exports into that market in general. Then when we look at propane, there was a drop of 496,000 barrels, still only 89 million below the 5-year average, 89,000 below the 5-year average. That will stay strong. But when we look at distillate, there's China's keeping some of that export quota diminished. You're starting to see the U.S. again keep some of that in-house. So you're going to see some fairly lumpy moves when we look at storage, and we continue to see it in Fujairah and Singapore. And we're going to talk about what does that mean for pricing and flows through Q1. Now, we dropped off the Brent one just because WTI Dubai Spread are moving fairly close together. It's at about $3.30 discount. So the discount is starting to widen again, which will keep... We will see WTI exports remaining fairly stable at about that 2.6 to 2.8 we discussed. This will make, again, moving us a bit closer to the lower end. Crude exports went from 2.9 to 2.55. And if you remember, we expected to close the year a little bit higher than we initially thought and much closer to that 2.8 level, which, we were right in line with kind of that 2.8, 2.9 on what the 4-week rolling average really looks like. So when we look at gasoline exports, you can see we closed out the year fairly weak, and just given where we are, we'll likely just start off the year right at that just above the 5-year average. But we expect this to be a little bit below the 5-year average, just given where some of the weakness is in Latin American demand, and that'll be a little bit of an issue as we go into Q1. Then when we look at distillate fuel oil exports, huge drop off. We expect this to continue in the beginning of the year, where we'll be below the 5-year average, just given where the market being the best in the U.S., you'll try to sell it in the U.S. Ethane exports, seasonally adjusted high. Again, we had new capacity come on this year, so exports will remain robust. 2022 will set a new record, but again, it'll just continue to be lumpy, and a lot of this is going to be pushed into China. Now, when we look at crude oil exports coming right into kind of this sweet spot of what we were talking about, especially when we look at the 4-week rolling average, which closed out at about 3 million, a touch above what we were expecting, but again, just right in line. And now we do think that this comes down a bit to stay within that 2.8, 2.9 million range. As exports of U.S. propane came down a bit, it still stayed strong. We still set a record for the year. And it's something that will remain elevated as we go through the rest of Q1. Now, when we start looking at flows, Libya has obviously had their issues, which has taken down some capacity. They did finish work on one of the pipelines, which will bring back about 285 to 300,000 barrels a day by 8 p.m. local time. So we will see some of that normalization. Some fields are still closed due to militia activity, which is taking about 350,000 barrels a day off the market, which is where you're starting to see that reflected in December, where they were kind of comfortably hitting 1.1 million barrels a day of exports. Then they came to about 1.036. And now, based on what we're seeing, we're estimating them to come in at about 860,000 barrels a day, which is really the lowest that it's been in a year. But this is going to be something to watch. And it's actually a positive for Nigeria. So far, Nigeria movements have been fairly slow, but we have it as well as Angola. But if Libya continues to remain at these levels, that will be a positive for Nigerian purchases and some Ural purchases into the market. As we said before, spot differentials of Russia's ESPO and SOCOL, as well as Qatar's Al Shaheen crude for February loadings, have slid by around $1 a barrel compared with last month. And remember, last month we saw a drop of $3, now $1 on top of $3. So you're continuing to see that slowdown. Cargoes of ESPO were recently sold at the lowest level since August, while the premium of Abu Dhabi's Murbain crude also slumped. So you're starting to see them trying to get more competitive, and especially ESPO and SOCOL, a lot of that was going into Asia, more importantly China, and China is just not buying at the same level that it even was 2 months ago. Libya expects its oil production to drop by a further 200,000 barrels a day over the next week as workers try to fix the pipeline. That has now been fixed. The latest outage comes less than 2 weeks after militia shut down the OPEC's biggest field, Shahara, causing output to fall by about 350,000 barrels a day. But then when we look at where the flows are in general, things will increase back up because of the pipeline. So realistically, we should be at about 850,000 barrels a day of production. BP sold Fortes at a bit higher. They sold it at minus 10 cent dated Brent, and it compares with what it was, which was negative 30 cents. So you're starting to get a little bit of premium coming back into some of the Brent market. which is a positive for the region, but it's still trading below dated Brent. Now, when we look at tank stocks, Europe had a very nice drop, coming to the lowest, seasonally adjusted lowest. It's been lowest of 2021. We do expect this to reverse a bit, but still remain in a fairly bullish backdrop. But we're expecting something a bit similar, where you get a drop in oil and we will get an increase in products. And that's where we had a little bit of an increase pretty much across the board except naphtha. And we do expect to see this accelerate, especially across the gasoline and gas oil front as we go into it. Well, this will be announced tomorrow at 10:30. Gasoline inventories, again, coming in at above the 5-year, above that 13-year average, which opens up additional exports into the U.S. And we do expect this to stay fairly stable as we kick off the first 2 weeks of the year. Fuel oils continuing to grind higher. There hasn't been as much demand for fuel oil in the market, which is, even though the ARB has opened up a touch, it's still keeping product fairly stuck within Europe. Now, when we look at Singapore, so Singapore closed out with a drop of about 1.9 million, just below the 15-year average. We were expecting to be right at the 15-year average. Instead, we were slightly below. We do expect that to make up the difference as we go into January. Resid is a bit lumpy. There's been some issues in terms of weather and getting things offloaded, which has delayed some shipments, which has created a little bit of lumpiness. That will reverse. Middle distillate was flat. We were expecting a little bit of a build, but again, that's something that is just a matter of timing. With light distillate, a small drop of 500,000 barrels out of storage. So light distillate still above the 15-year average, as we were expecting to close out right around these levels. And we expect it to hold this level as we go into the first week of Jan. And then when we turn to middle distillate, we had a nice bullish close. This will start to creep a bit higher, but still remain below the 15-year average, still be in a fairly bullish position when we're considering middle distillate, while resid closed out right at the 15-year average, and we expect it to just kind of stay around these levels or really maybe creep up by about 500,000 to a million barrels a day. So when we look at Fujairah had a build of 529,000 barrels, which was an increase week on week of 3.3% and a reversal of last week's draw. Total stock build was driven by the increase in light distillate and heavy resid. So when we look at light distillate, rose 410,000 barrels a day, reversal of last week's fall of 887,000. The East of Suez was reported well supplied, with China's West Pacific or WPAC seen in the spot market offering loading. So one of the things that we're seeing in gasoline is we're seeing more cargoes getting put into the spot market coming from Asia, which is kind of capping that East of Suez, which is why we do think light distillate in both Singapore as well as Fujairah see some steady increases. Middle distillate, including diesel and jet, fell 487,000 barrels, reversal of last week's small gain of 7,000 barrels, and it's the lowest level reported since July 1st, 2019. Sentiment in the ultra-low sulfur diesel market strengthened with expectations of, again, lean supply, as you're seeing some restrictions on gas oil and diesel. They're starting to loosen up a bit, but they're still fairly tight, which is keeping the market a bit concerned, which is why guys are going out and buying from storage a bit quicker than I think they'd like. China's quota is expected to be delayed, so January volumes will be like December or slightly less. Now we know that it is less. Supply still seen constrained to some extent, again, which is keeping things fairly bullish. We do expect to see a little bit of an increase, but that's more of timing. We do see middle distillate remaining in a fairly bullish backdrop. Heavy resid rose 606,000 barrels, continuation of last week's rise of 601,000. Bunker demand at Fujairah stayed fairly subdued. There were weather issues. There were shipping issues. So we do see some of this softness remaining in the shipping market. Brent time spreads had a nice bounce. This is again showing we've now moved March to April. That is showing some of the strength in the curve, which again, especially when you look at the front month. So now when we look at some of the movements in refining remains fairly static when you're looking at some of the numbers and margins coming into Singapore. which is incentivizing some of those additional runs, which is why we do think some of that gas oil and middle distillate demand will be met, and you'll start to see some of that creep into storage, but still remain in a positive landscape and fairly bullish for pricing. So on the the Northwest Europe, Ural side, staying at the highs as Europe continues to see that demand for gas oil, as well as some of that gasoline ending up in the U.S. markets. The question is going to be, how much does Omicron impact activity through January? We saw the German leading indicators and PMIs falling into negative territory, actually showing contraction, which is something that will put some of that weight on where growth and underlying demand will go. The Mediterranean Urals, hydrocracking, refinery margins, when you look at kind of where things sit in general, things remain fairly robust. And as Libya falls off and people rush out to go buy additional cargoes, it'll be Urals and obviously Nigerian, as we said. So supertanker crude imports closed out the year at a seasonally adjusted high. That's something that will remain elevated as we go into the beginning of the year. But when we look at floating storage, you can see that we closed out just below where we were for 2020. But we're going to stay elevated, and we're actually going to be above the high point in January of 2021. So 2022 will be above 2021, and we'll see, again, a lot of floating storage, especially in Asia. North Sea closed out the year at the high, above the 5-year average. We think it kind of stays here. There was that delay in terms of the drawdowns in Europe. Onshore, that'll start to correct itself as we go through the remainder of January. West Africa had a big spike. We've seen some buying slow down. Libya, bringing back that pipeline a bit sooner, is going to cap some of that Nigerian demand that we were hoping for, while Angola still struggles to sell about 10 to 12 January loadings. Then when we look at Middle East, one of the things that we've been talking about is it's important to look at what is happening in the Middle East in general. As you can see that it kept creeping up. We did see some discounts come in at the end of the year to try to clear some of this glut. And you can see that they normally do this when you look at what happened in 16, what happened in 19, as well as 18, where you get this big drop. Obviously, because you're coming from a higher point, the drop was on a seasonal basis elevated. But we are going to start January at a high level. It's obviously not where it was in 16 and 17, but you're going to see that we're going to kind of be in this no man's land. And that's why February is going to be so important for what are OSPs and what does that pricing look like, which we should get by either today or tomorrow from Saudi Arabia, as Europe closes out the year close to the 5-year average. And we think that January is going to kick off right at that 5-year average for floating storage. So if you have any questions, you know where to find us. I apologize for not being able to respond right away to some of the comments. I took a little bit of time off to be with family, but now we're back and I'll be more engaged again. And so if you have any questions, you can find me on Twitter or again in the comments section of YouTube. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.